In 1720, London was drunk on a dream. Streets buzzed with whispers of untold fortune. A company, its name, the South Sea Company, promised wealth beyond imagination: gold, silver, and trade monopolies from across the world. Investors lined up in carriages, merchants mortgaged their homes, and the British elite poured in their life savings. Within months, stock prices soared 1,000%. But behind this dazzling illusion hid something darker, one of history's greatest financial disasters, a bubble so enormous it shattered lives, corrupted governments, and nearly bankrupted an empire. Even Isaac Newton, the man who could calculate the motion of planets, would lose everything trying to predict the madness of men. This is the story of the South Sea Bubble, the world's first stock market crash, and the lessons we still ignore. Part 1. The Promise of Empire. It began with ambition. Britain, fresh from the costly War of the Spanish Succession, was drowning in debt, over $50 million, a staggering sum for its time. The government needed a miracle, and the South Sea Company offered one. In 1711, a group of powerful men led by the cunning Sir John Blunt proposed a simple, seductive deal. The company would take on a portion of Britain's national debt in exchange for exclusive trade rights with the Spanish colonies of South America. Gold, silver, slaves, whatever could be sold or stolen would pour into London. The promise sounded irresistible. Newspapers called it the beginning of a new age of British prosperity. Politicians hailed it as economic genius. And the public, they were intoxicated. Owning shares in the South Sea Company wasn't just an investment. It was a status symbol, a golden ticket to the empire's future. But there was one small problem. Britain was still at war with Spain. The so-called South Sea trade couldn't even exist. The company's wealth wasn't coming from exotic markets. It was coming from selling shares of a fantasy. Part 2. The Birth of a Bubble. The year is 1720. London's coffeehouses, centers of gossip, trade, and speculation, are electric. Everyone is talking about South Sea stock. Carpenters, bakers, bishops, and barons all have one thing in common: they believe the price can only go up. The company's chairman, Sir John Blunt, was a master manipulator. He convinced Parliament to convert more government debt into company shares, promising huge future dividends. To make investing easier, he offered easy credit. People could buy shares with borrowed money. It was the perfect formula for mania. Soon, the stock price shot from $100 to over $1,000 a share. Ordinary citizens quit their jobs to speculate full-time. Servants became gentlemen overnight. A widow could invest a lifetime of savings, and in days, find herself rich beyond belief. London's streets filled with wild rumors. Some said the company had discovered mountains of silver in Peru. Others claimed it would soon control all global trade. Even King George III became an investor. How could it fail? But deep inside the company's ledgers, there were no mountains of gold, only mountains of debt. Part 3. The Madness of Men. Isaac Newton, the world's most brilliant mind, watched the frenzy unfold with caution. At first he made a tidy profit, cashing out early as prices soared. But as the mania reached fever pitch, even he couldn't resist. Newton re-entered the market, convinced he could ride the wave one last time. When the bubble burst months later, he lost everything. He reportedly sighed, "I can calculate the motions of the heavenly bodies, but not the madness of men." His loss, worth several million pounds in today's money, became the ultimate symbol of human folly. If even Newton, the genius of reason, could be blinded by greed, what hope did anyone else have? If this sounds ridiculous, remember, people in 2021 were spending millions on pictures of apes. The collapse was as violent as the rise. By the summer of 1720, cracks began to show. Investors needed new buyers to keep prices high, but the public's money was drying up. When a few prominent shareholders quietly sold their positions, panic spread like wildfire. The Bank of England, terrified of contagion, refused to bail out the company. Newspapers turned from cheerleaders to executioners overnight. Within weeks, the stock price plunged from $1,000 back to $100. Thousands of families were ruined. Merchants went bankrupt, noblemen fled the country, and London's prisons overflowed with debtors. The government launched investigations, exposing a web of bribery and corruption. Many members of Parliament had accepted bribes from the South Sea Company to push favorable legislation. One observer wrote, "The nation became a hospital full of madmen and beggars." The king's mistresses, the royal court, even the Chancellor of the Exchequer, nearly all were implicated. The scandal rocked Britain to its core. The aftermath was brutal but transformative. The British economy teetered on collapse, but out of the ashes rose a new kind of financial order. The Bubble Act of 1720, ironically passed at the height of the mania, was meant to stop fraudulent companies. Instead, it crippled legitimate innovation for decades. But, more importantly, the South Sea disaster forced Britain to rethink how markets worked. The Bank of England gained power as the lender of last resort. Government borrowing became more regulated, and public trust, badly shattered, had to be rebuilt brick by brick. Yet the real legacy wasn't in laws or ledgers. It was psychological. The South Sea bubble revealed something terrifying about human nature, the desire to believe in easy wealth, even against all reason. 3 centuries later, the same story keeps replaying. In the 1929 stock market crash, millions believed the good times would never end. In the dot-com bubble, investors threw billions at websites with no profit, no product, just hype. In the crypto mania of recent years, fortunes were made and lost on digital promises of revolution. Different centuries, same story. Every generation thinks it's smarter than the last. Every bubble begins with a whisper. This time is different. But it never is. Whether it's 1720 or 2020, markets rise not on profits, but on belief, and belief once broken can destroy empires. Behind every chart and collapse are human stories. In 1720, shopkeepers lost their shops. Servants who dreamed of wealth returned to poverty. Families were torn apart. Suicides surged. The newspapers that once glorified the South Sea Company now printed lists of the ruined day after day. The tragedy wasn't just financial, it was moral. The same politicians who had fueled the mania now sought to punish the guilty to save themselves. Sir John Blunt, the architect of the bubble, was stripped of his fortune and banished from public life. But for the common people, there was no justice, only ruin. And yet, as the pain faded, so did the memory. Within decades, the bubble became just another cautionary tale, buried under the next wave of optimism. The South Sea bubble is more than history, it's prophecy. It warns us that markets aren't rational machines. They are mirrors of human emotion. Fear, greed, and the longing to belong drive prices more than any spreadsheet ever could. When the crowd believes in a fantasy, reason becomes irrelevant. In 1720, it was South Sea trade. In 2000, it was the internet. In 2021, it was digital coins and meme stocks. Different assets, same psychology. The lesson is brutally simple. Hype is more powerful than truth. And we are all vulnerable to it, even Newton was. 3 centuries after the crash, Britain recovered. The empire expanded, the markets evolved, and capitalism marched on. But the ghost of the South Sea bubble still lingers in every boom and every bust. It whispers through Wall Street, through Silicon Valley, through every market where dreams are bought and sold. It reminds us that human nature never changes, that every time we think we've learned our lesson, we prove we haven't. So the next time you see a chart that only goes up, a headline promising guaranteed wealth, or a friend telling you that you're missing out, remember 1720. Remember the people who lost everything chasing the illusion of endless profit. And remember Isaac Newton, the man who could measure the universe but not the madness of men. This has been Financial History Uncovered, and I'm Andre. If you found this story powerful, hit like. Share it with someone who loves history and subscribe for more deep dives into the money that built and broke the world. Because history doesn't just repeat itself. It rises and crashes, just like the markets we create.